So, and there's going to be other days that maybe you didn't do any business at all when you were driving in your car. So technically those miles that you drove those days are not going to be tax deductible. But, you write off 20,000 miles at 58 cents. That's $3,400. Sorry, take that back. That's $11,600 that comes off of your gross tax return. And let's say that you're in a 30% tax bracket with IRS and state. Now, for me, I'm up there. I'm up and over like 45, okay? Well, let's just say that you're in 30. That's $3,400 tax savings in your pocket. How many people thought that they drove 20,000 miles last year? I know I did. I drove a lot more than that business-wise, right? So, right there you're seeing some out-of-pocket tax savings right there that you can immediately figure out to be able to have that offset your taxes. Now, okay, let's take a look at I gotta remember my next pages. Okay, so there's two different ways that we can look at legitimate tax deductions on vehicles. All right. This is the easiest way is the percents. Now, I noticed that I think it went down like a cent or something for 2020. Then it went back up for 2000, or went down a little bit for 2021, like by a half a cent. But then it went back up for 2022. So you guys all know, like definitely you can Google this stuff to find out what the current rate is. I think I even did like a history search earlier today on this. So, make sure you're studying this a little bit. Obviously, you're not really going to give this amount to your CPA or tax person or whatever. Anyways, they're just going to want to know the miles, and then whatever system you're using is going to automatically calculate, what the value is for that deduction. But here's the other thing. You can take miles, which means if you have multiple vehicles in the household, miles is sometimes easier. And you don't have to really keep track of your gas receipts. You don't have to keep track of your repairs. You don't have to keep track of your oil changes. You just take miles, right? So if you do that, that works probably for 90% of the people that are running side hustles and businesses, right? So you're probably in that 90% category. Now, if you start doing better and you're more into this and you've got more money coming in from side hustles and more money in your W-2 and you've got to offset more taxable income, then your next step is to be a little more aggressive, and it takes a little bit more energy. But now you start to deduct cars. All right, you start to deduct cars right off of your depreciation schedule. So when you purchase a vehicle, then you're able to deduct that and offset your taxes that year based upon that purchase. Now, you usually have a choice with your tax person whether you want to do a fast depreciation or a slower depreciation. Most of us are choosing to go as fast as we can. And in some cases, and believe me, this is one of the biggest tax amazing advantages that we have here in the United States, is we have the ability as business owners to write off a Section 179 purchase. So if we have a vehicle that has got 6,000 pounds in gross vehicle weight, 6,000 pounds. So that's one of the reasons why, I stepped it up to a full-size Lexus, one of my first vehicles that I could tax deduct for business, rather than just a Jeep Grand Cherokee at that time. That was a smaller one. I wanted to get to that 6,000 pound range, so now I could take the full deduction. And if you take a look at, for example, my X6 that I drive around, I've had it for a long time. That thing was over 6,000 pounds. It's a beautiful car. It's a quad turbo. It's fast as heck, but it's a heavy car. It's still up and over that, so it qualifies for that qualification, that deduction. Pickup trucks, four-wheel drives, Hummers. Oh my gosh. Now you guys might know why I like the Hummers too, right? So these become a full tax deduction. Now, big corporations go out and buy a lot of equipment, new tractors, new fleets of cars. And I think they can even go up to I don't know, $2 million or something on some of these Section 179s for equipment purchases in 1 year. So, it just depends. Like, you have to hit a couple qualifications, and don't mark my words completely on all this, because at the end, I don't want somebody coming back to me later and saying, hey, Jeremy Stansel said I did this, and you did it, you got audited, and they threw it out. I'm going to teach you what I've had thrown out of my audits and what I haven't. Would you guys like to know that? So I'm going to walk you through that, okay? I've been through this. All right, so first of all, a vehicle that you write off on a Section 179, it needs to be used more than 50% of its miles for business, okay? So if you have a vehicle, and as long as you use it 51% of the time for business, it's now eligible for your Section 179 deduction, okay? Now remember, if you're just taking miles and you're not doing the full deduction, you're just taking miles, it doesn't matter whether you have, bought something 6,000 pounds. It doesn't matter if you're driving 2 or 3 vehicles, as long as you keep track of what you're driving that vehicle's miles, and that's what's important. But on Section 179, you've just got to prove that it's more than 51%. Now, here's the kicker. You still got to prove, like, if you wanted to still take the full depreciation of that vehicle, then you got to prove that you're using that vehicle literally 100% of the time. So here's what I do. I either have a separate personal vehicle that is just for personal errands, that in a case of an audit, I can basically show that I have this vehicle that's got lots of miles on it, it's kind of a beater or whatever, that's for my personal use. And now that I'm, got something more serious for really going out and doing my USANA business and, picking people up from the airport and transportation and, delivering products and so on and so forth, that one's the one that I analyze as my Section 179, and I might still back off the deduction, maybe 10% or 20%, so that I'm still showing some personal use on that vehicle. Because obviously, the IRS, they're also going to think that you're still not driving that vehicle for sure 100% of the time for business use. Now, think of it this way. My dad has his technical installation services business, Nandigo Carpets. We have a family carpet business. Within that carpet business, at some peaks, we have 30 employees. Now, his fleet of vans that we have for doing carpet install are all kept within a warehouse. When the guys are done driving at night, they've got tools and equipment and all that in there. Is my dad able to still keep all of those equipment or all of those vans on 100% tax deduction? Absolutely. Is it going to get challenged that much? Probably not, right? But if I have something in my own garage and I'm like, can still maybe use it for personal use, technically, there's a couple ways to handle this. As long as I keep good mileage logs, then if I'm ever challenged on it, there's really nothing they can say about it. That's it. That's all it comes down to. Now, in my big audit, I didn't keep the mileage logs. But one thing I was good at doing was I always used credit card transactions wherever I went. My entire life came through personal business transactions, came through all these different things that I'm doing has an electronic trail, okay? So that electronic trail, my sister, many of you know that my sister used to work for me as my personal assistant in my accounting, and she hated it. It took her like 6 months to go back and build my mileage logs and track my butt around where the heck I went during all that time, because everywhere time I left the house, I didn't go anywhere without spending money. So she just had to go back and figure that all out, which vehicle I was using, go back and look into my cloud and see what vehicle I might have been driving for the day. Was I making a post on social media? And kind of like put that all together. Now, most of you may not have as many cars as I did. So there's several business cars. So that kind of became more challenging for her to do that. But also, here's what the IRS says. If you just keep track of your miles for about a 3-month period out of the year, they'll take a sampling for that, and you don't have to keep track of them the whole rest of the year. Right? So, if you do a good job at that, and you're still wanting to take these deductions, then don't feel like you have to track every little thing you do. As long as you are, being being the best you can with it. That's the key. All right. Now, the other big thing about taking Section 179, maybe it's a vehicle that's not 6,000 pounds. Maybe it's another automobile that you purchase. Well, now you can deduct, though, all of the expenses: gas, tires, repairs, all that stuff. Now you have more pieces on your Schedule C or on your actual itemized return, as we start talking about other entities we're going to use here in a minute. But now you break all that down, right? So big question you might have is, what's better? Taking the miles, like we were talking before, at 58 cents a mile. We're doing a Section 179, and then taking your actual expenses. Typically what I've found is the larger your vehicle purchases get, and the more money you spend on that kind of stuff, then the more that this becomes more valuable. I have a travel coach. The travel coach is expensive. The last one I purchased was $460,000. My travel coach is really a motorhome, but I use it for business. I used it for over 51% business. Immediately, it was thrown out of my tax deduction or on my audit, because I had to go back and prove that I'd really used it for business over 50% of the time. Was I able to do that? Absolutely. So as we went back and forth and did our appeals and had somebody help me do that kind of stuff, I had it be able to. It was added back in. So that was a win. Okay. I had the big yellow truck that I had purchased to tow the boat that I had, and that was legit. It was completely deductible, no problem. The Lamborghini was thrown out, right? But guess what? My CPA and the attorneys were smart enough, because they know how important that was for business and what I did with it, that even though I didn't put it on a Section 179, I actually wrote it off as a lease, which is the next way I'm going to teach you how to write off business cars. I got them to still bring that back in, and I never had to pay any taxes or penalties on the Lambo. And I actually got it published in Utah state law, so it's there now. And the last person that got a Corvette that legitimately coming back into a court case like that was like 15 years ago, and we used that case to be able to start proving to the IRS and during the investigation that it should be legitimately used. And that was not an easy win, but eventually we won it. Okay. I did a lot of marketing with the Sandrail. Some of you guys saw that. That one was a big price one. It was a Section 179. They threw it out. I could not get that one back. Did I have to pay taxes and interest on it? Yes. Was it a problem? Am I looking at anything criminal? No, because it's a gray area. I really thought that it should be tax deductible. I'm marketing it. I got graphics on the side. I'm giving out Rev 3. I'm building my business with it. I'm having a blast. Why can't that be tax deductible? So that was thrown out, right? But I couldn't get that one back, right? So you're not going to be able to win everything if you go through, the audit process that I did at that type of a level. All right. Here's the other thing with a Section 179. This part. If you deducted the whole purchase, let's say you have a big tax year, like you've made really, really well money in 2022. And let's say that you want to go buy yourself and reward yourself with a $100,000 car. You could finance that car at a low interest rate and still deduct the entire purchase of what's on the contract of sale to offset your taxes for that year by $100,000. Now, it would probably make a tax credit for you because it would make such a big swing on your taxes, but that's carried forward year after year, right? So you can apply that tax credit to the following year. But here's the kicker. If you go to sell this vehicle, each year it shows, let's just say it depreciates each year, which it will. If you go to sell that vehicle in 2 years, and let's say you sell it for $70,000, well, you've deducted the $100,000. You're going to have to take that $70,000 as taxable income in your gross category on your business return. So people that typically buy and sell vehicles and maybe get a new one every couple of years or whatever, Now they can still offset that because they go buy another one that's 100 grand. And so they just make an adjustment on your return. So it still ends up pretty much being a wash. So you're not really going and paying that taxable amount. But if you sold the vehicle and you no longer had a vehicle like that again, or you didn't go buy something else to now knock down that amount that came back onto your tax return, then, that becomes an issue. So that's something you have to think about. All right. Now, we guys talking about how you can deduct your straight automobile expenses if you're doing depreciation. If you don't do a Section 179, then the standard way of doing it is a depreciation schedule. And first year is usually a max of $25,000. So if you buy a $50,000 car, you're going to deduct $25,000 of it, regardless of whether you finance it or not. That doesn't matter. You can finance it. And remember, the payments you pay on the car as interest is all tax deductible too, right? But so you take $25,000 first year, and it'll depreciate over time. Now, I will tell you this, if the IRS deems that it's a luxury vehicle and that's all you're using is for luxury and you're not really using it for business, they could throw that out, right? Now, you might have already been using the vehicle and got deduction out of it for years, and maybe they just go back 1 year and you pay a little bit of tax and interest for 1 year. All right, now, last option. So we've talked about the Section 179 depreciate. Well, first of all, we talked about miles. And then talked about now deducting the car, which you can do a Section 179, or we can do a standard depreciation schedule, or we can do leasing. All right. Who's leased a car before? Your hand up. Yeah, got a few people? Yeah, okay. So what happens on leasing? On leasing, we have probably the least likely chance to have it thrown out in an audit. And the reason for that is because it goes in your rental category on your tax return. It doesn't even itemize the car out that you bought, right? So in my opinion, if you're really worried about it, or if you're adding more and more cars to your business lineup of vehicles, then it's probably smart to move some of them into a lease. So, or when you buy it as a lease, because the lease is basically 100% tax deductible. There is some sales tax on that lease here in the U.S., and I don't know how that happens in Canada, but that sales tax may or may not be tax deductible. So you have to cover that with your tax advisor. But with a lease, you are leasing the vehicle, then you turn it back in, right? Most of you know how that works. You can do a 24, 36, 48-month lease. You don't technically own the vehicle in your own name. The leasing company does. You pay usually less in payments than you would on a finance, but you never know. It just all depends on the vehicle. Sometimes you pay more, and then you work on your residual values. And if you want to buy the car at the end and finance it, you can do that. But on the lease, the main reason why a lot of people do leases from a business standpoint, it's just easier, and it kind of just is not as complicated when it comes if you're really wanting to deduct these things. So are you still technically supposed to show miles on the lease? Yeah, but I mean, still, you get to deduct all the tires, the repairs, the maintenance, the car washes, the fuel, everything that goes into that car is still 100% tax deductible, or whatever percent you're using it per business, right? So I can't advise you on which is the best way to go on vehicles. I just got to tell you, it's one of the most common things that come up on trying to figure out tax strategies and how that works for you. All right. So, important tips. What would have saved me from having my big tax audit in that year? Actually, at that time, it wasn't TIF that was doing my taxes with my CPA, but it was at those years that I finally shifted out and let my ex-wife, she was running all this most at that time, do it, and it wasn't a bad thing. There was one small mistake that she made. She didn't make an adjustment for personal use that year, and there's always adjustments we would make every year. So the first thing the IRS did is they went in and they looked at my contract of sales for vehicles that we were showing as business, and then went in and saw that we were taking 100% of the deduction of all of the expenses, gas, tires, everything, with no adjustment back, we'll say on 10% use. And we didn't have a personal vehicle in our fleet. Everything was registered, as much stuff as business as we could. We were showing it as business. And that's another thing too. Try to register vehicles, leases, and things like that with also, if you're doing an LLC or you're doing an S Corp or some type of a business name or a DBA, anytime you can add the business name to it, then it'll really help in terms of, if it comes back later in an audit. Now, believe me, there were still things that were titled in my personal name, and I can still take them as a Section 179. I mean, there are just, if you're financing or leasing them, a lot of times these companies are just not really going to put it in a business name. Only usually if you're paying cash for the vehicle is it easier to put in a business name, but still I usually get them to write it in both. So I have a couple of holding accounts or LLCs. I'll put in my personal name and then add that to it in the registration process when I'm buying the car. Okay, so make your adjustments for personal use. Don't mess up like I did on that one. That one cost me a little bit. And honestly, we've been doing personal use allocation every year anyways. That was the first year that was really, honestly, just a clerical error. She just had forgot about it, when we were doing our taxes. All right. Now let's get into the less aggressive things that probably aren't going to be that big of a deal. I don't know if any of these are going to be looked at that close or not if you're really ever audited anyway. So let's talk about these. Is travel tax deductible? Okay, well, let's think about that for a minute. In your mind, if you're going on a trip and you're doing business work, I would deduct the whole thing 100%. I don't know about you, but everywhere I go on a trip, I'm always still making money. I'm still meeting people. I'm making connections. When Sierra and I just went recently to Huntington Beach, California, I'm telling you, I came back with more contacts in 1 week than I had ever been sitting at my home doing other business for months. So it's easy to justify and show my conversations with those people, my meetings. I took selfies with them. And so, I'm definitely, and I have associates. I'm meeting people in Huntington Beach that are actually in my downline too. And if I'm taking somebody on the trip and they're in my downline and I'm also working with them on that trip, then it's easy for me to deduct 100% travel. Now, you may choose if you're going to do that or not. You might have a certain percentage. Maybe you take 10% of that trip and you don't write off all of it. And you make some calculations so that if you ever got audited or challenged, you can show that you put in a personal allocation. So if you do it on like one trip a year and you spent so much money on it and you're really worried that could hurt you later in a tax audit and pay some taxes back on it, do a personal allocation and you're safe, okay? Now, clothes. Unfortunately, no. I wish there was a way. Now, the only ways you can legitimately tax deduct clothes is if they're logoed. So you can have a logo on them. So if you really want to put, I'm going to come back to that. Yeah, I'm going to get to auto order here in a second. If you legitimately put USANA or your side hustle or your side business on your clothes and it's clear, you can tax deduct that legitimately. Now, if you have to go speak, like if I had the Big Diamond University event and I'm going to do an extra new suit or whatever for that, and it's $1,000, unless I take the time to get it embroidered and having my logo on there or my SCI logo or whatever, it's not tax deductible. I can still deduct it, but if it gets thrown out, then I'm probably going to have to pay a little bit of tax on it, right? So here's the biggest misconception when it comes to people that work in a hair salon, and they feel like they have to wear clothes that kind of match the hair salon, and they've got, now if they have an apron that holds their tools in there for now doing the hair work, that's tax deductible. But if it's just clothes that, so then what happens is if it's just actual clothes, but they're not specialty clothes, then, forget it. Now, if they're uniforms, absolutely, they're tax deductible, right? So if my dad has some of our guys wear a uniform and it's logoed with our company stuff on there, then of course that's going to be tax deductible. So another reason why to buy USANA logoed merchandise. And the other thing is too, it's really up to you, Nathan, whether or not you want to be that aggressive with just the initials. You could do it, take the deduction for a lot of years, and maybe they throw it out, maybe they don't, if they ever really analyzed and looked through all of your specific one-off expenses on this or that or another. USANA auto order, your personal usage of USANA products are not tax deductible. I wish I could tell you they are not. So what I always did is have my auto order go through on one card, which was personal. And then I would do all of my other orders on business, right? So it just shows that personal usage again, because if you're deducting 100% of your USANA products and you're saying this is for sampling, marketing, distribution, building your business, well, it's kind of like they're going to say, well, where's your personal use on this stuff? You don't use it at all? So, I mean, a lot of this stuff is just common sense, right? But I'm sure you're buying more products than that over and above your auto order here and there. And so it's kind of easier to show that and probably not going to be looked at, right? Because most of that really is for sampling or to give out or to help market your business. Okay, are USANA samples deductible? Absolutely, yes. Are groceries deductible? No, but yes, sometimes. So when I was running around in Sierra and we're running up our heads cut off to get groceries in this house for the Diamond University Phase 1 event and everything that went along with beverages and all that in the house, those specific purchases were absolutely 100% tax deductible. Why did I take photos of all of us as a group setting, all eating food? Why did I have some photos of me making food and making dinner and that kind of stuff? It just shows evidence that these are those things that if they ever came back in an audit and said, hey, we noticed that you write off some groceries sometimes. I go, whoop, 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 right to those Diamond University photos. I'll show them an example of me, writing off some the one grocery bill of Smith's was like literally $700 or $800, So it's like, did I take that as a deduction? Absolutely. Okay, sometimes if you have a bunch of people over and you're having alcohol, can be super expensive, right? Again, if you go by to the regular store and it's like where you buy other liquor or whatnot, it's kind of like you shouldn't be writing it off. But if it's for a big group and you're having a big barbecue and you're promoting USANA during the barbecue, take 10 minutes, put some USANA products out on display. Take 10 minutes. Now everything you're doing from the grocery store is now tax deductible. Okay? All right. Yep, groceries and supplies for USANA events are absolutely tax deductible. Yep. Okay. One of the questions in here too, before I get too far in this chat, so I don't come back to it, I know we're kind of jumping around a little bit, but it has to do with the health savings account. So that was a direct message. I'm going to come back to that in a minute. So there might be some more questions around that, but that one just becomes a little bit more complicated. So we will get to that. All right. Events, anything to do with events, 100% tax deductible. You have, services, fees, team manager, anything to do with Zoom, any of that kind of stuff, subscriptions, training, all of that are all tax deductible, right? Anything that you're doing for personal growth and development, coaching, tax deductible. There is a place to be able to itemize that, or you can just put it in your operating expenses and not itemize it all the way that far, unless you had to down the road if you had just a lot of stuff going through that category. Equipment. So here's the thing on equipment. So what do they count equipment? All right, so let's say that I buy a camera and I'm using all my cameras all the time for Zooms and everything else we're doing anyway. So I'm going to legitimately tax deduct them. But if you put them in just your operating expense, there's not a category for equipment that's in your operating expense that doesn't actually want to itemize it on your return. So technically, the way my CPA has always told me, if it's a purchase of $300 or more, you're going to get the full deduction. They're not going to depreciate it, but they do have to itemize it on your return in your Schedule C. So if you go buy a new computer and it's $4,000, okay, guess what? You're going to be able to deduct the full $4,000 purchase. Again, the IRS doesn't care whether you've actually paid for the computer or whether you're paying payments on the computer. What they're going to look at is the actual purchase price. Now, again, you'll be able to deduct it, so it's okay. They're going to itemize it, and that makes it feel cleaner and better for your CPA too. And then technically, if you sell the computer, the reason why they want equipment itemized is because if you sold the computer next year and it's worth $3,000, they want to make sure that you're sticking that $3,000 back into your business account and showing it as income because you did deduct the full $4,000. That's the reason that they have you itemize the expenses like that, right? So if you don't do it, I'm not saying you're going to get audited because normally they're not going to really probably dig in that far on it. But if you're like running a company that has like multiple computers and you're writing off quite a bit of stuff and equipment, then it's probably really smart you do that. And honestly, I've pretty much always followed the rules on equipment throughout these years. And if it's realistically over $300, I'm usually just giving that to my tax guy and then just itemizing them out. It's no big deal. After a couple of years, your tax guy will just drop them off of your Schedule C or off of your itemization. Not a big deal. Phones, same way. And phones get complicated because you have upgrades on phones all the time, right? So sometimes it's just kind of a constant thing on phones. I will tell you that phones is probably the easiest thing for the IRS to probably all right, it doesn't really matter. As long as you're just paying your monthly thing to Verizon or AT&T, honestly, they probably aren't really going to care. They're not really going to try to ask you for that kind of stuff, getting that detailed. All right. All right, so there's another one on here that I must have lost a page that was out of here. So let's talk about that before we get into proving expenses. And does anybody know what the other big expense is that I haven't talked about yet? That is probably a pretty big one. It's definitely massive on my return. It should be talked about right here. My page must have fallen out. Does anybody know what it is? Yeah, so, and just to answer Steve, automatic monthly order for USANA operation is tax deductible or not? It is not. Now, let me ask you this, Steve. Let's say your monthly auto order, you legitimately were using half of that order for personal use and half of it to go out and market and sample. Then the half of it that you go out and sample, you could split that in two and say on an allocation that here is personal use allocation on this purchase I put through on my business card. So that's the difference. That's up to you. That's exposure. You'll have to think about. I have never had the IRS go in and look at my actual expenses. So all this stuff we're talking about, travel, clothes, all those kinds of things, they've never even looked at. So all the years I'm trying to keep track of all this and keeping track of all the evidence for them, honestly, they didn't even get into that anyway. So, I mean, it's there and it's all legitimate, but they didn't even take the time to really get into that stuff. So sometimes you can overthink all of that, but just, do your best to try to keep the accounting on it straight. But this next one's a big one. So the next one is meals and entertainment. All right. So on meals and entertainment, this is something that actually is starting to be a pretty big dollar item. The reason that for years, there were so many entrepreneurs deducting all of their meals and entertainment, 100%. And it's just hard. It's always hard to when you're out, doing business and you're with different people, it's hard to know whether it's 100% business or not, right? So business owners and entrepreneurs just ended up just deducting it all. So eventually the IRS just said, you know what, we're just going to give you a straight 50% deduction on all of the meals and entertainment that you can put together. And they're probably not going to mess with it too much unless you have some crazy, amount of money going to that category and it just throws your whole return off somehow. But otherwise, you get a 50% deduction. And here are the only things you have to prove. One, and now we get a bigger deduction. I'll talk about that in a second. But you only have to prove if you're having a meal with somebody or you're taking somebody out to do some entertainment somewhere, if they're within a 60 or I think it's a 50-mile radius of your home base. So if it's still local, then you've got to take some notes, or take a picture or something just to be able to legitimately have evidence if they ever called you out on it. Now, if you're talking some pretty smaller transactions, I wouldn't worry about it. I have some of my transactions. I have some leaders I've taken out to dinner, and I have my whole family there, my USANA family. And, these are huge leaders, and, it could be a really pricey dinner, maybe in thousands, maybe up to 5,000. I had one time, one was 8,000. So am I going to deduct that? Absolutely. The thing is that if it's more than 50 miles away, or you've traveled on a plane somewhere, you don't have to prove anything. You don't have to say who you're with. You don't have to have evidence of it. They're just going to go ahead and give you that deduction at 50%. Now, the good news is that for 2021, the IRS has opened it up and now giving us the same exact parameters, but now 100% deduction. So let me repeat that. That might be the biggest little piece of tax savings right here that you're going to get for 2021 taxes. And it was all worth it, sticking on this thing with me for over an hour, if you wouldn't have known. And that's that 100% of your meals and entertainment are tax deductible here in the IRS, or in the US, for 2021. All right, so that's going to make a big difference for sure on my taxable amount for this last year. Okay, now, do you have any questions around meals and entertainment? Car insurance is absolutely deductible if you are depreciating the vehicle. So if you're depreciating the vehicle, it's on your depreciation schedule, you use it for more than 50% business, and you're taking real deductions, gas, new tires, car washes, all that, rather than mileage, then you can deduct the car insurance. If you're taking 58 cents a mile, then you're not taking actual deductions. They're just going to go and give you 58 cents a mile. Then you couldn't tax deduct your car insurance. But you might still make enough money in tax savings to be able to have paid for your car insurance anyway without that tax liability, right? So that's the two differences. Okay. So David Monteith, so the meals in a restaurant are absolutely 100% tax deductible for 2021. And prior to that, you get a 50% deduction for meals in a restaurant. Probably one of my biggest expenses is meals and entertainment. I go out a lot. I'm always still doing business. I'm meeting people. I'm typically out with Sierra or someone else that's actually in my business too. If I was with my ex-wife, we're talking business, we're talking strategies. And we'll kind of get into a little bit about that too here in a few minutes on when we start running entities. Okay, now, one time I was really bummed out, but my tax guy said, nope, it's not happening. I had worked so hard, and my mentor had this cool Rolex watch, that he used to have on stage. And a lot of other people did too. So it wasn't just him. And any kind of side hustle or business or sales and stuff out there, a lot of times it's just a big deal to have a nice watch. I had paid a lot of money for that watch, and I had tried to tax deduct it. And he looked at me and he said, okay, if we do this, you're probably going to get audited. Let's put it this way. If you get audited, there's no way out of it. You're going to have to pay the taxes and interest. So you have to decide if you're going to take that big purchase and deduct it, and you might win it, but he feels I feel like it's tax deductible. I really do, because I use it for marketing and sales. But, at that time, that was an aggressive move. And I'm glad that I have a CPA to bounce ideas like that are outside of the norm. And I did not take the deduction. It really made me mad, because when I was purchasing the watch, I was thinking, oh man, I'm going to tax deduct all this. But later realizing, oh crap, I'm not going to be able to do it. Because I don't really want to open the door on something stupid that ends up just being a lot of work for me to have to go in and now track, I'll get all my mileage logs together, get all my other stuff together they're going to ask about. And so it's just not worth my time to actually, to go and do it. Other than that, jewelry, again, so I was trying to talk to you. Jewelry is not tax deductible unless you owned a jewelry store. Now, my buddy has a side hustle buying and selling Rolexes. I thought, what a great idea. Now you can actually, if you really like Rolexes, then you can try to tax deduct them, make some money, but actually write them off too, right? Okay. So, how do we keep track of all this stuff? So, it used to be when you're still kind of getting started with side hustles and, going back and figuring out your expenses. And I got to say that there's some of you that might be listening to this right now, and you haven't even done taxes for a few years. And a lot of the younger generation, like, they kind of just get busy, and sometimes they're making cash, and sometimes they're doing deposits, sometimes they're not. And so it just becomes not a big thing to, like, get their taxes done. Let me tell you that there's no way to escape taxes. So the longer you wait, the harder it becomes to remember all of the expenses and what happened those years. So in someone else that I had been in a relationship a number of years ago, she hadn't done taxes for a lot of years. So I just taught her how to do Excel and how to learn to actually use columns and do expenses, and I just put basic categories of expenses. And then she went into all of her bank statements, every bank statement she could get. Some of them she had login access to, some of them she had to contact the bank and wait weeks for them to mail those statements to be able to try to find anything that she could find that she could use to offset the deposits that she had coming into those banks. So then she did this. The only income she really needed to try to put in there was the accounts that she had deposits in, right? Or she had a W-2 or a 1099. So she didn't have any W-2s or 1099s. So she had to go and find all of her banks that she had stuff in, and then figure out what all the deposits were. And then that was her gross number, right? Now she had to start coming up with the ideas of how to do these expenses and writing those down and putting them into Excel. Those total categories was all that she needed to give my CPA. That's it. My CPA didn't care about making sure that she did the right, transaction on putting it in the right expense or whatever. I taught her how to do that. She went through and did all that. She gave the totals to my CPA for each year and then spit out the taxes that were due, and then worked out a deal with the IRS to be able to pay those back at a lower interest rate and to be able to knock some of that off and get that handled so everything was up to date. So Excel is the easiest way to do that, or numbers with math. Personally, I like Excel the best. The next way to handle your accounting, and it's beautiful and you're going to love it, is QuickBooks Online. So if you're not running a QuickBooks Online account, that's your next move. QuickBooks Online is so cool because it basically logs in to each one of your bank accounts, credit cards, checking accounts, whatever you can basically do, any kind of business transactions, and it basically syncs every transaction you do. And then you can either go in and what's called reconcile. All right. Yep. Cindy loves QuickBooks Online. You can go in and reconcile each transaction. Now, here's the thing. It remembers. So if you go in and make an itemized transaction and you reconcile it, and if it's in the right place, otherwise you move the expense category, the next time you go to that vendor and you didn't even realize it, you went to a supply store and you go to that same supply store, it sees the transaction. Automatically, it puts it in that category. I don't have to enter every time I'm buying Delta airfare. I don't have to go in and type in all that stuff like we used to have to in the olden days. When it sees a Delta transaction come up, it automatically is going to stick it in travel. When it sees a hotel come up, it's going to automatically put it in hotel. Now, you either got to go through and at least accept and reconcile all that, or that's when you pay somebody in your CPA office to do it. But guess what? You're not paying the CPA to do it. You're paying a lower wage employee peanuts that does it so fast, and they do it every day, that literally it's not going to cost you hardly anything, and they just go in and reconcile all this for you. And so they spit out the guts of your tax return, and they give it to now your CPA to go ahead and have you sign off on it. And it's all based upon all of that syncing and making sure that you have your accounts logged into QuickBooks. I literally have so many transactions that go through on my accounting every month, you would die. You would freaking die. If I actually had to log every single transaction, it would be impossible. But literally, there's so many of those transactions that are tax deductible. And there are some transactions that are not tax deductible. And if I accidentally use my business card for a non-taxable transaction, and I do it again, and I reconcile and do it again, it's okay. It just goes over to my personal or taxable income. So it's pretty easy. So it's okay if I don't have my personal card out running around with me for the day, not a big deal. I can still use the same card and have that synced and figured out in QuickBooks. All right, so next thing, separate accounts. Now, it used to be that when we teach people how to have a side hustle, you got to legitimately show to whatever government you're working with, Canada, United States, Australia, whatever, you're going to show to them that you are a legitimate business person. So it used to be that you needed to go get a checking account that is set up for business transactions, right? And then you have another checking account that's your personal. And so that's how a lot of times, for a long time, we always had our two cards, and that I still do today. I'm using my two cards, and if it's business, I'm doing it on business. If it's personal, it's personal. When Sierra goes and gets groceries, she should be doing the personal card. If she's going and doing something business that has to do with our, things that we're working on, then she's going to take the business card. And sometimes she has both of them. She has to make that decision at point of sale with what's it going to be. Now, a lot can still go through business as long as you have a good CPA and things are being synced. Then the IRS is really never going to go back and say, "Oh my gosh, did you really put that on a business card, or did you put that on a personal?" And sometimes we get freaked out. We're like, man, when I was younger, and I didn't have that much money going through my accounts. I was so careful, making sure it was perfect. And even after going through a huge audit, they never even looked at that once. They didn't even care. They just honestly looked at the totals, and then they didn't really punch into those individual transactions, right? So do them and have them correct. But I used to say, make sure you have your separate accounts perfect. But even if you're blending an account, then my advice, and I'm not giving you legal advice, I'm not your CPA, I'm not whatever. I'm just saying, in my experience, I would not be as concerned about that as making sure you just have a good accounting method down, and you have had some track record of identifying what are your personal expenses, what are your business. And if you have a track record for doing that, you've got a routine, and it's a great routine, then it's accurate, then it's probably not that big of a deal. Sometimes it's not easy to get separate accounts. Sometimes it's not easy to have to run multiple checking accounts. Sometimes it's not easy to run 3 or 4 different credit cards and try to make sure those transactions are all done properly. So, you can be a little less stressed out as long as your bookkeeping and your accounting comes back. All right. So now let's talk about entities. So here in the U.S., we have the W-2. We've already been talking about that, which that's from getting income from corporations, basically a C corporation or an S corporation, a partnership that they're running employees. They do withholdings and everything else. FICA, right? So they pay a little bit of your withholdings. Now, Schedule C, you can still have a W-2. And you just itemize your expenses out on your Schedule C. Right? That's how you offset this W-2 income. But there are some additional advantages if you step it up and go to an LLC, a limited liability company. A limited liability company is pretty simple to get here in the U.S. And you can it's going to cost a couple $100, but you can do it online, and you can legitimately set one of these up, and it gives you now more of a protection. So like the larger your side hustle income gets, the more you want to legitimately protect those tax deduction stuff, right? So the LLC doesn't use necessarily a Schedule C is like just you're trying to do with a W-2 and you're just a sole proprietorship. Now with an LLC, you have a whole set of accounting that is just for your business. So technically, you don't really even need to do accounting on your W-2. It's just like hard numbers. It's just, here's your gross income. Here's the gross amount of money that you withheld for Utah tax. Here's what it was for some medical expenses. Here's what it was for a health savings account, whatever. But itemized stuff really is just going to be shown to your CPA that really comes through. Hopefully you've set up a checking account now that goes just to that LLC, and then you can tie your QuickBooks to that. Do you need to tie QuickBooks to a personal W-2 income world? You don't need to. I don't. So my QuickBooks, I don't even mess with my personal, because I just don't put things through business as personal. So if you can, set up QuickBooks to an LLC. And then here's another thing. This can get a little complicated. I know I'm running out of time, so I'm trying to get through this as fast as I can. But if this isn't for everybody. This is for the smaller percentage of you that kind of are going to get to that point, or you're at that point where you are ready to even take things to the next level in terms of having even more protection and being able to also have a couple of other advantages that you can't have with an LLC. The S Corp is what I do. So an S Corp means that you're still self-employed, but now you have to be a little bit better at having some corporate meetings. So you have to kind of figure out who else are some of the directors of your company. You don't have to pay them income and all that, but you have some meeting minutes. There's some standard ones online. It's really simple to prove these. And, if I have a partner that I'm connected with in that business, then, going and having a meal or having a set time, and we're just writing down some of the goals, some of the things that's happened. How do we want to improve the business? Just at least stating that now works for your meeting minutes. Okay. So by doing an S Corp, here's the thing. I pay myself as a W-2 employee. So I don't really get W-2 from someone else, but I pay that to myself. And I have a legitimate salary that I pay, and I do withholdings, state withholdings, and Fed. So that amount is pretty low, though. And because I'm not showing my entire income from all of my businesses, I'm only doing my salary. Now, that I have to do withholdings on. The rest of the money that comes into my world outside of my W-2 is going to count as passable income to me as royalty. Royalty, or not royalty, but dividends. They come to me as dividends. Now, dividends are taxed differently, right? They don't have to do with holdings on them. And in some countries, you don't even have to pay tax on dividends. Now, I could be wrong, but when I used to work in Hong Kong and I was building business over there, the big business guys I was working with, they loved it. And they always tried to talk me into doing businesses over there because they told me that they're not paying any income tax on dividends in Hong Kong. So literally they can take all of their income and be tax-free regardless of whatever businesses they're doing in Hong Kong. So check with your country and find out how they handle dividends if you're an owner of a corporation that you legitimately will say own. And if here's the other reason I do S Corp, and this is for liability protection. So it helps to protect my assets or my income generating assets so that they can't be, we'll say, attacked. And I'll tell you guys, there's something else really big that I didn't know if I was going to talk about on this Zoom or not. But I think it's just so valuable for everybody to understand. The larger your business world gets, the more that you have a target on your back for someone to come after you for lawsuits. So if I got in one accident where I was in snow and it was my fault, and I've had one pretty much my entire life. And it wasn't that big of an accident, realistically. But because of who I am and the research they did, that has escalated into a full lawsuit. And that lawsuit is a really big lawsuit. The good news is that I already paid high insurance to protect myself, but I also pay an umbrella policy on top of that for personal liability protection. It's ridiculous how these people are going after this in this lawsuit, but they just go out. It's because they are looking at what we'll say income streams and stuff that I've done, even outside of USANA. So I'm not trying to mislead anybody here or anything at all. But I have a number of things going for me. I already had higher insurance on those vehicles than normal people do. I had an umbrella policy on top of that. But on top of that, I have my business layered into an S Corp, which is actually then layered into a living trust that owns that. So I've layered assets and big things so that from a liability standpoint, this has nothing to do with the IRS and nothing to do with tax savings. But this just has to come down to entities. So as you're starting to think about entities and how do I structure entities for tax savings, but at the same time, still be able to do it for tax savings. That's the key, liability and tax savings. So that's what I did. And thank God I did, because here it is firsthand, here in 2022, the first time in my life I've ever had to deal with something like this And thank God that I'm in good hands. And my attorneys say I'm in good hands. I might still have to freaking go to trial and be on deposition, all that crap. But there's no way that they're going to be able to come in and be able to get what they've done, or at least go beyond what my insurance coverages are. Okay, so that covers that. Now, that might have sounded confusing. So let's just I almost forgot the reason I do this.